Welcome to RSI Part 2, presented by DailyFX Education. You'll recall from the first video we introduced the RSI indicator and discussed how it can be used to interpret readings of overbought and oversold market conditions. In general terms, an overbought market condition occurs when the RSI values increase above 70. An oversold market condition occurs when the RSI values fall below 30. We then discussed how a market could remain overbought or oversold for extended periods of time when prices are trending strongly. Therefore, we discussed filtering the RSI signals, only considering those in the direction of the daily trend. If the daily trend is up, we only look for buy signals. A buy signal is generated when the RSI falls below 30, entering oversold territory, and then crosses back above the 30 line. When the trend is down, we only look for sell signals. A sell signal is generated when the RSI rises above 70, entering overbought territory, and then crosses back below the 70 line. Another strategy we talked about in the first video is trading RSI divergence. Also, we talked about how the markets are fractal, and that RSI can be used on any time frame, though we recommended using it at least at a 1-hour bar or greater. We then finished up the first video with a discussion of common input values for the RSI indicator. In this video, we're going to build upon the basic ideas we discussed in video 1. We'll discuss 7 other ways to use and analyze RSI. When we conclude the video, you'll have 9 distinct ways to use RSI in your trading. So let's get started. The first topic that we'll cover is the failure swing. The traditional overbought and oversold signals we discussed in video 1 can become more valuable when combined with other RSI signals. One such signal is called the failure swing. Wilder, the creator of RSI, referred to a special case of RSI divergence as a failure swing. While it's best if a trader waits for a signal from the underlying price chart, such as a trendline break or an indicator crossover, after spotting RSI divergence, the failure swing generates a buy or sell signal in and of itself. A bearish failure swing occurs in this fashion. First, RSI rises to an overbought level above 70. In this example, the RSI reaches a peak of 73 in this area, and then declines. The decline can either bring the RSI down below the overbought 70 level, or perhaps just bring it back towards 70. In our example, the RSI line retreats to 66. As Wilder points out, this movement towards 66 can be made up of several minor up and down fluctuations. After making a low at 66, we then need to see the RSI rallying. This is the next component necessary for the development of a bearish failure swing. However, as the indicator rises, it reaches a second peak that is lower than the first peak. In this example, it only reaches 71. After reaching 71, the RSI breaks down again and moves below the previous low of 66. When the break below 66 takes place, this completes the failure swing. When this happens, the pair is given an RSI sell signal, and the trader can go short. Conversely, a bullish failure swing would be the opposite of what was previously described. The RSI would fall below 30, for example, then rally up, fall back towards 30 but not passing through 30, which makes the failure swing, and then break above the previous high. Wilder thought that failure swings that occur above 70 and below 30 on the RSI scale are strong indications of market reversals. Indeed, these are strong signals, but just like any other indicator, it's best to only take the signals in the direction of the daily trend. The next application we'll discuss is RSI pattern interpretation. Often, patterns formed by the RSI indicator will bear similarities to patterns formed in the price action itself. Additionally, RSI patterns tend to form a bit quicker than price patterns, which could allow a trader to anticipate potential price movements. By focusing on the RSI, as Wilder notes, a trader can see chart formations that may not be obvious on a bar chart. Given that the RSI is plotted as a point, it forms a line chart instead of a candle or bar chart. These line graphs dictate the kind of patterns RSI forms. The most common formations are head and shoulders and a variety of triangles. A head and shoulders formation can form over a very short period of time, such as a few days. In this case, a minor top in the pair is likely. This pattern should be watched carefully if it forms above the overbought 70 level, or the inverted head and shoulders forms below the oversold 30 level. Should the RSI head and shoulders form over a long period of time, these patterns are more significant and can signal important reversals on the price chart. On occasion, they'll correlate with a trendline break on the price chart. To expand on this concept, let's take a look at a chart. Do you happen to see any candle pattern on the chart below with which you might be familiar? In roughly the middle of the chart, we can see a loosely configured head and shoulders. Oftentimes, these patterns are more readily identifiable on the RSI than on the price chart. We can see how the RSI as an indicator offers the trader something far more than just identifying overbought and oversold territories. To assist with interpreting the pattern, and to gain a more detailed look at how to trade it, let's look at this expanded view of the chart. The rule for trading a head and shoulders pattern is to wait until price action breaks the neckline of the pattern, and then a short position could be taken. This rule could be applied to both the price chart as well as the pattern on the RSI indicator. Once a candle or the RSI closes below the neckline, a short position would be taken at the open of the next candle following the break. Our stop would be placed above the right shoulder. The profit target would be twice the distance from the top of the head to the bottom of the neckline, represented by the gold line on the chart. These price patterns, when combined with divergence and failure swings, can give strong warnings of upcoming movement on the price chart a day or two in advance. The third and final topic of this video is using support and resistance levels on the RSI to identify trading opportunities. A trader who is using trend lines on a price chart is simply identifying areas where prices have not traded through. A similar concept can be applied to the RSI indicator, where zones can be identified where the RSI has not dropped below or risen above. A trader knowing this information can anticipate a bounce up off an upward sloping support line, or wait for a break through these trend lines to initiate a trade. Here's an example of a trend line break on the RSI. Notice how, as the prices move up, the RSI moved up as if it were supported by the black trend line. At each touch of the trend line, the trader could have entered the position to go long. However, with prices in a downtrend, we want to look solely for short sell signals, which would be in the direction of the daily trend. Eventually, prices did break through the line, which is our signal to go short. Sometimes, these trendline breaks can precede trendline breaks on the price charts, giving a trader warning of a change in direction. Also noteworthy is that the RSI reading of 50 is considered the center line, a key point in the RSI. A reading above 50 indicates that average gains are higher than average losses, and that buyers are in control. A reading below 50 indicates the opposite. This is noteworthy because many traders consider the RSI crossing over the 50 center line to be an extra confirmation of what the RSI is telling you. Also, if the pair is trading in a range, the RSI will tend to be moving within the 50 level, an area on the RSI scale that is referred to as the neutral zone. In a nutshell, if the relative strength index is below 50, it generally means that the pair's downside potential is greater than its upside. When the relative strength index is above 50, it generally means that the upside potential is greater than its downside potential. The RSI is a popular trading tool because it can also be used to confirm trend formations. Let's say that you think a trend is forming, or wondering if an uptrend will continue. If you're looking at a possible uptrend, then be sure the RSI is above 50. If you're looking at a possible downtrend, then be sure the RSI is below 50. Here's a 4-hour chart on the dollar CAD showing both of these scenarios. A trader could find a confirmed uptrend and then use the RSI to find the oversold levels within the uptrend as an entry point. This would entail looking for a pullback on the RSI indicator itself. Conversely, you could use it with a pair that's in a confirmed downtrend to find the overbought areas to initiate a short sale. To avoid fake outs, we can wait for the RSI to cross above 50 or below 50 to act as confirmation to confirm our trend. Keep in mind that this by no means represents absolute confirmation, but as in other cases, merely is another way to analyze the movement of a currency pair to establish a higher probability trade. A chartist by the name of Andrew Cardwell expanded on Wilder's interpretation of using the 50 level as a trend confirmation tool. First, Cardwell noticed that uptrends generally traded between RSI 40 and 80 levels, while downtrends usually traded between RSI 60 and 20 levels. Cardwell observed when price action changed from an uptrend to a downtrend, and vice versa, the RSI will undergo what he referred to as a range shift. Let's take a look at a chart to see how this scenario plays out. Based on this chart, we can see how the RSI confirms that as the direction of the trend changes, a range shift takes place on the indicator itself, as the RSI moves from the lower 60-20 range to the upper 80-40 range. The RSI has long been touted as one of the premier indicators to be employed when trading a range. Since in range trading, a trader would be going long at support, the bottom of the range, and short at resistance, which is the top of the range, by virtue of the way the RSI moves between upper and lower ranges itself, it's easy to see how that premise evolved. Let's take a look at an 8-hour chart of the Aussie Swiss, where the pair has been oscillating within a loosely configured range since mid-November. We can see how price action nicely coordinates with the buy and sell signals provided by the RSI. In the case of each selling opportunity on the chart, the RSI had been above 70 and then closed below it. In the case of each buying opportunity, the RSI was below 30 and then closed above it. This chart presents some compelling data for using RSI in a range trading scenario. In closing, we've identified several applications and uses for the RSI indicator. Some of these uses can even overlap, where you can get several confirmation signals from the same RSI indicator on your chart. For example, you can find divergence, a swing failure, and a break of RSI trend line on the same setup. This can help add confirmation to the strength of your trading signals. After having viewed these two videos on the RSI indicator, it can be seen that proper use of the tool can benefit traders in many more ways than simply identifying overbought and oversold levels of currency pair. This concludes our video. We invite you to attend a live webinar with our course instructors on the RSI indicator. In the webinar, instructors will discuss real-time trade setups on the RSI and field live questions and answers on the topic of RSI. Thanks for watching this video, and we look forward to seeing you in the live webinars.